Welcome to the Long-Term Investor. Today, I'm joined by Steve Liberatore, who is the head of ESG and impact for global fixed income at Nuveen. He is also the lead portfolio manager for Nuveen's core impact bond fund, short duration impact bond, and green bonds funds. And we haven't really talked about ESG bonds on the show, and that's why I was so thrilled to get some of your very valuable time, Steve. I don't read that many bios often because I end up stumbling through them or mispronouncing, but I have to share a couple highlights on just what showcases how deep your knowledge of this space is. So Steve, you served on the ICMA Green Bond Principles Advisory Council and were a member of the initial executive committee. You're also a member of the UN Capital Development Fund's working group on the climate insured linking resilient infrastructure finance. And you serve on the UN's Joint Sustainable Development Goals Fund Blue Economy Investor Advisory Group. Lastly, the last thing I'm going to point out is that you also serve on S&P Global Ratings ESG Leadership Council. Steve, thank you so much for joining me here today.
Peter, thank you for having me. And as I've joked, thank you for calling me old in the nicest possible way.
Wise, experienced, vibrant, helping taking care of our earth through your impact work. And generally speaking, the world of responsible investing in fixed income is less widely known versus in equities. So I was hoping you could just start us off by elaborating on what responsible investing looks like in the fixed income space and the benefits of fixed income investing with respect to sustainability.
Yeah, absolutely. And it's interesting because, on the fixed income side, we're kind of used to always being, second fiddle to what we see in the equity markets or other, what we consider higher flying type sectors. Historically, the concept of impact investing had really been focused primarily on private equity and venture capital. And what we have done has been able to, over the past decade or so, shift the narrative to get people to understand the opportunity to be impactful investors and improve sustainability and increase opportunity for investors to really get exposure to unique, different types of assets or investments that have those types of characteristics. And really, it was something that made a lot of sense because if you think about the nature of how fixed income operates, you don't need to be a public equity to issue fixed income, right? So we have obviously corporate debt, but we also have agencies, NGOs, we have municipalities, we have global supranationals. We also have structured securities where you're looking at pools of assets like asset-backed securities or commercial mortgage-backed securities that have a direct and measurable outcome associated with the capital underlying those. And it's really a unique opportunity that people were not really aware of. And now that we talk about that and we're able to get investors to understand the types of investments we're making and what's available to them through fixed income, I think there's a real excitement and an understanding for the ability of public fixed to really drive impact investing, especially when you think about the need to scale it.
Well, it's really interesting. And you make a great point that I hadn't thought of before, that if you're not a public company, you can't issue public equity. So really, the opportunity set is probably enormous, if I had to guess. And maybe you could take us through some of what that process looks. Why don't I and maybe it's the same for both your core impact fund and your short duration impact fund, but in terms of when you're looking at the available unit, when you look at the available universe, how do you incorporate this responsible investing into your process?
Sure. And what we do is really two steps. And this, I think, speaks to, again, the unique nature of public fixed and the ability to get access to very specific outcomes through the structuring of a transaction and being able to control the proceeds. And that's not something that, you can do in other asset classes. And so that's why I think it's really a unique opportunity to look at fixed income and public fixed income, especially for these types of sustainable opportunities. And the way that we look at it is really twofold. We bring the concept of ESG leadership, where we're determining through work myself and my team do with our separate responsible investment team and third-party data providers to find and identify what we would call our eligible universe. And those are going to be issuers that are best of industry class on environmental, social, and governance criteria. And it allows for us to really identify those issuers that we believe are leading the way in their respective sectors on those three key factors. And we combine that with impact investing. And in that case, how we define it is we have our own proprietary impact investing framework that we created back in 2007, myself and our current head of responsible investing, Amy O'Brien. And we review it annually, update it where we need to, but it's really focused on the concepts of transparency and disclosure. And what we're looking for an impact investment is a security that has a direct and measurable social and or environmental outcome associated with it. And that's really why public fixed is such a great opportunity set, because of the ability to control how proceeds are utilized in those transactions.
Well, that's really interesting. So just to kind of summarize and ask some follow-up questions. So when you're screening for ESG leadership, that's maybe the part that people are more familiar with on how people choose public equities. And so it's not that there is a direct impact by allocating capital to that company, unless you're helping lower their cost of capital by funding them. And it's really this impact investing where you have the direct and measurable outcomes. And you guys have a wonderful impact report. I'd be kind of curious on how you decide what is measurable and what sort of things you're looking for and what is a meaningful impact in order to justify inclusion in a fund.
And this is, one of the challenges that we've always had in the responsible investing space, which, I'll translate into an opportunity. It is the fact that we've always used a lot of different acronyms and we've changed what we've called it, and the concepts are interrelated in a lot of ways, but they're distinct. And there is at the moment just a tremendous amount of misinformation, lack of clarity around exactly what you're trying to do if you're utilizing ESG factors in your investment process. And I think that it's unfortunately been politicized. And I think that's because it's really not explained or understood exactly what you're trying to do. So when we are looking at ESG leaders, what we're trying to do is evaluate an issuer based upon environmental, social, and governance criteria, because we believe that there are financial implications to how an issuer performs on those three factors. And it's especially important in fixed income. We're an asymmetric payoff asset class, right? So how you outperform over time isn't by picking winners, it's by avoiding losers. So what we're doing with ESG analysis, and if you're doing it correctly and including it into your portfolio construction process correctly, you're simply identifying the best operated and managed issuers. So over time, they're going to have a more stable free cash flow profile because they're taking into account a wider array of risks to their operations. And because of that, they're going to have a more stable free cash flow profile. And as an asymmetric payoff asset class, that stability of free cash flow is critical to us being repaid. So really, it's an enhanced form, in our view, of really risk mitigation by identifying those issuers that are the best operated and managed. And as such, in a more volatile market, we expect our ESG leaders to be the ones that are going to lead performance because, again, they're going to have a more stable free cash flow profile. The impact investing side is slightly different. What we're looking for there are direct and measurable outcomes. Can we invest in a geothermal power plant? Can we invest in a series of affordable housing projects? Can we invest directly in opportunities where we're funding gender lens investing and providing capital to underserved populations? And all of that combined, and the impact investing, because they're a little more unique, they're a little more esoteric, they carry a little bit more spread because they're not as well understood. So in an up credit cycle, the impact investments we believe are going to be the ones that lead our performance. So combining these two concepts where appropriate in a portfolio, you're going to, they're related, but they're distinct. And so you want to combine them. And that, I think, puts us in a position to be able to outperform regardless of the market environment while delivering to investors, in the core impact bond, for example, a true core fixed income experience, just with dedicated ESG and direct and measurable impact. And that is a very powerful combination when you look at long-term opportunities.
Well, and I like that you emphasize the point that in fixed income, it's more about avoiding the losers than picking the winners. And I have several questions on the impact side that I do want to dive into, but one more kind of quick question on the ESG leader side is maybe you could, and I don't mean to put you too much on the spot, but if you could give us some sort of an example, real or hypothetical, of how the ESG data informs you about the
Sure.
credit quality of a given bond?
Absolutely. The one sector that I love to use, because I think it's the one that is most, discussed, right, or least well understood in this space, is oil and gas. There's a belief and a misperception in the marketplace that if you're utilizing ESG criteria, that you do not invest in oil and gas names. That is not true. What we're trying to do, and it's the perfect sector to identify what we're trying to do. We're not saying don't invest in oil and gas. What we're saying is you want to invest in oil and gas issuers who are the best stewards of the environment, because over the long run, they win more business, they have lower long run CapEx requirements, they're fined less. So as a result of those three factors, they have a more stable free cash flow profile. So they're more likely to be able to repay you over time. So I think that's a great example that hopefully helps people understand what we're trying to accomplish by utilizing this criteria and how it translates into a potential financial outcome.
I love it. That's very useful example. And digging into the impact side, you guys are one of the largest investors in responsible investing just to begin with, but particularly when it comes to impact investing in fixed income. So could you talk a little bit more about your engagement efforts with the issuers and underwriters and the types of first of its kind environmental and social deals you've helped bring to market?
Sure. Yes, we've been fortunate over time to be able to have an investor base that has allowed us to continually try to expand what we're looking for and how we're trying to deliver capital in ways that lowers the cost of capital for issuers or pools of assets or technologies that we think have a more sustainable future. And what we're trying to do, and that all really revolves around our engagement. We've been doing this long enough, and now we're large enough that I think we've been able to build up a good reputation in the market for being innovative and thoughtful and willing to look at new, unique, different types of structures that others can't or won't. And we benefit from having, more than 50 people on our analyst teams across all sectors within fixed income, more than 20 traders, and myself and my team. I've been doing this a little over 20 years, and my team also has, substantial experience. So we're able to utilize our expertise and experience to evaluate a lot of different types of transactions. And that usually starts with our engagement. So last year in 2021, myself and team had 164 different engagements where we spoke with issuers, industry groups, but primarily issuers around structuring impactful transactions. And so we're reached out to get our views on how a structure looks. Is it something we'd be interested in, or what would they need to do in order to bring us to the table to participate? And so that's a really critical function for us because it allows for us to be involved up front. And in fixed income, it's an over-the-counter market as well. So everyone is treated differently except at new issue. And how you're treated at new issue is going to really depend upon how much impact, no pun intended, you've had in the structuring of a transaction. So if you're able to participate early, you're able to direct the outcome in a way that it fits your frameworks and also what your investor is looking for. So it really allows for us to discuss with issuers, the types of outcomes we're looking to finance, the types of data we would need back from them to validate that outcome. And then also the overall structuring of the transaction, the pricing, and hopefully our allocation. So that early and often engagement is really a critical function in getting us to a place where we're comfortable with a transaction that fits what we're looking for and we know our investors want us to invest in, but also from a performance standpoint, going forward.
Well, and you guys have led the work with some really fascinating projects globally. And they're green bonds, they're blue bonds. Actually, maybe I should start there. Would you mind defining what a green bond versus a blue bond versus an orange bond versus a brown bond? People probably didn't realize that there was a rainbow in their fixed income portfolio.
Yeah, that is very true. Especially as the market continues to evolve, we continue to see a broader and deeper opportunity set from an impact perspective. So this is really a great time to be involved in the market. So a green bond is simply a transaction whose proceeds are being utilized to fund an environmentally beneficial project of some sort on terrestrially. So on on ground, basically. A blue bond is a transaction that provides funding for investments that have an environmental benefit but are ocean-based. An orange bond is a transaction that provides funding for gender equity opportunities, providing capital to underserved women globally. So usually, the definitions of these are fairly consistent. It's really about where the capital is going and who is benefiting from that deployment of capital.
And so with those definitions in place and who's benefiting, that's really where I'm kind of curious is you have some amazing projects globally. I'm curious if when you are funding a project, again, you have a dual mandate of sort, you want to create impact, but you also want to generate an investment experience that is mimicking something like a core bond holding. So that's a tough thing to balance. When you are looking outside the U.S., I see you have a rhino bond in South Africa. I have to know what that is. When you choose to do something outside the U.S., is that to be consumed globally, or is it more designed for the U.S. investor?
It depends. The proceeds usually from a security that would be considered a Yankee security. So, it's a foreign issuer issuing in dollars, for example. Generally, you're going to be benefiting someone outside of the U.S. But what we're looking at is we are looking globally for these opportunities. So you brought up the rhino bond, which is actually the first wildlife conservation security that's ever been issued, and it was issued by the World Bank. And the proceeds are funding wildlife conservation for black rhino population growth in 2 game parks in South Africa. And the repayment of those bonds comes with what is called a success payment. So depending upon the growth rate of the black rhino population will determine the ultimate payout on the transaction. So it's an inaugural type of transaction that we believe really has the opportunity to be a template. A lot of the inaugural deals we work on, whether it's the rhino bond, the Seychelles blue bond, the IFC forest bond, we're trying to set up securities that look like templates so that we can utilize them going forward to deploy capital more efficiently and more effectively going forward. One of the things, that we think about, when we're looking at these types of transactions is ultimately we want to deliver capital to those issuers that are being impactful and our ESG leaders. We want to lower their cost of capital over time. And in a lot of instances, there's an opportunity not only to benefit that particular issuer, but the issuers that come after them as well. And I always use renewable energy as the best example for this, whether it's solar or wind. Those are technologies, right? There are no fuel costs. So just like semiconductors, and I always forget the name of this law. It's the equivalent of Moore's law for solar panels. The more that you invest in it, the cheaper it becomes, the more efficient it becomes over time. So we believe that if you're investing in solar today, you're helping to reduce the cost for the next solar project and the next wind project going forward. So that helps you to get you to that place where we are now, where depending upon where you are in the US, your cheapest form of marginal power at the utility scale level is solar in the Southwest and it's wind in the Midwest. And now you're getting to a point where this concept of delivering capital and lowering that cost of capital is transitioning the conversation into one that's a financial decision, not purely a conservation or a sustainability issue. And I think that's a real tipping point to really transform the way that investors and the markets think about how to invest responsibly.
So that's interesting that you mention that the more you invest in something, the cheaper it becomes later. And you also emphasized a little bit earlier on just about how important it is to be at the beginning of something so you can influence the structure. So when you're looking at these projects globally and even domestically, what impact do you see them having on the fixed income space as a whole?
Yeah, it's really starting to change the nature of the fixed income market as a whole. And certainly, the one area I look at would be what we call GSS bonds, or global or green, social, and sustainability bonds. And those are labeled securities that are coming to market that are, in alignment or believe that they're in alignment with the ICMA green bond standards or the social bond standards or sustainability bond standards. And I think that's a good proxy for where the market is going. And last year was the first year we eclipsed $1 trillion of issue. We now have $2.5 trillion worth of outstanding paper right now. So it's still a very small portion of the market as a whole, but it's the most rapidly growing. And you kind of have seen that this year as well. While overall fixed income issuance is down over 20% simply because of the volatility that we've seen, rising rates, more volatile spreads. You look at the GSS market, and it's going to be down pretty materially as well this year, but the green portion is only down about 4%, relative to where we were last year. The social bond space is down pretty material simply because a lot of the drivers there for the past couple of years were COVID relief securities. And so obviously we seem to have moved past the main point of concern around COVID. And it very well may come back, but at the moment, we're feeling a little bit better about how we have a handle on it. So I think that's where you're seeing some of the drop off. But when you look at that real green portion only being down about 4%, really gives you a sense of how that's performing relative to the rest of the market. And all of this is simply being driven by investors, right? Investor demand continues to increase. Whether you're an institutional client who's focused on the fact that their regulators, their clients, their employees are more and more interested in their overall sustainability approach, more of a stakeholder approach. Even equity investors are increasingly interested in how you're performing on sustainability metrics. So it's a way to respond, to those concerns and to talk about them and discuss a way where you're able to show how you're benefiting society and the environment, what you're doing to improve overall sustainability and address those concerns. And on the individual side, the two fastest growing groups of investors are women and millennials. Those two groups also have the highest preponderance for wanting to incorporate ESG or impact into their investment decisions. So I think what you're seeing is simply a response from increasing investor demand and understanding of what is actually occurring with ESG utilization and impact investing, and the fact that we're getting to a place where we have long run results now from investment products that are utilizing these concepts that can now apples to apples comparison against those that don't utilize ESG or impact. And you have a longer run ability to now view that comparison and be able to determine which one really is a better fit for you. One of the main misperception that remains in this space is that you sacrifice performance to be a responsible investor. And that is simply not true. Responsible investing and capitalism are not mutually exclusive. They work extremely well together when done correctly. And now we're getting to a place where you have long run performance metrics that are showing the opportunity that is available to someone if they're looking for those types of investments.
Well, I can speak at least on what we do at PlanCorp. It's that evidence, both the research and, like you said, the actual track records that made us comfortable not just reactively offering ESG portfolios to clients, but proactively offering them to clients. And I will also anecdotally support what you said, that it is millennials and women who tend to show the most interest. That doesn't mean that other groups, age groups, and genders don't. We also have clients from across 44 states. And I sort of thought that there'd be certain states where there would be an outsized interest.
Mm-hmm.
And maybe that's a little bit true, but it's pretty evenly spread, which has been really interesting. Thinking about how much the space has changed, and really you've been at the forefront of a lot of this. If we were to fast forward 10 years from now, how do you think the space looks different? And what are some things that you hope change, even if you are not sure that they will change?
Yeah, and your point the 2 points you just made are really critical. That there is a wide amount of interest, right? And this crosses genders, races, political views, political affiliations. And it's really an interesting time and a great time to be involved in this. And one of the things that I have found more than anything is that for an advisor working with a client, the ability to talk about ESG and impact allows you to have a far more holistic and deeper conversation with them, because you're getting at a heart to what it is they're trying to do. And I remember one of the first advisors I ever spoke to, more than a decade ago when I started managing these types of portfolios back in 2004, he said something that was just really insightful. He goes, "We never lose clients because of performance. We lose clients because they no longer think that we know what they want." And talking about ESG and impact allows you to bring to bear a concept that goes beyond just risk and return. But what is it you're really trying to get accomplished with your capital? And when you're able to produce things like an impact report, and you can show the investor, hey, your capital went to providing funding for renewable energy projects that generated 450 million megawatt hours of power last year. Is that a lot? Is that a little? No idea. But when I see a translation to that being enough for, over 20 million average US homes, gives you a sense of the magnitude that of the investment that you're making. So I think that the opportunity is really there to really expand and deepen the conversation. And where I think we're going to go from there is, I think going forward, we're going to have much more granular opportunities to invest from an impact perspective. One of the really exciting things that we're seeing is being able to get closer to the actual impact. So the rhino conservation bond is a good example, right? Where your performance on the security is going to be tied to the growth rate of the black rhino population, or the opportunity set to invest in gender lens opportunities. And the Women's Livelihood Bond series is one that we've been very active in, that's providing capital to underserved women in Southeast Asia. And it's doing it in such a way that you're seeing not just societal benefit of increasing incomes, more stability, but also environmental benefits, where you're providing sustainable farming concepts and metrics and education to women farmers. So there's a lot of different opportunities there that I think are really more inclusive of where individuals are and what it is that they really want to specifically invest in. And obviously renewable energy is a huge driver. And the one, to me, ultimately, that I think has the greatest opportunity, in my view, is really on the asset-backed security side. And that is the funding of solar loans and leases. So one of the things that, we've all been told, right, and it's not correct, is that being more sustainable will cost you money and that it's expensive. And where we're getting to now, we've been very active in the solar loan and lease ABS security market. And I think it's the one that's really got the opportunity to change that narrative. Right now, the average, weighted average FICO in these transactions is 750, right? So it's the prime of the prime. But if we're able to get that down to, say, 650, that opens up all of middle income families and individuals. And what it would do is be able to show the opportunity for you to put solar on your home and reduce the cost that you pay for power. And it allows you to really flip that narrative completely on its head and change a discussion at the macro level. And just like what we've seen with how the MBS market has made homeownership more affordable, if you're able to make the financing of solar arrays more affordable, at the same time that the long run trend, absolutely not the last couple of years because of supply chain issues, but the long run trend of cost for solar arrays is coming down dramatically. So if you're able to marry that current force in the market with a reduction in cost of capital, affordability rises rapidly. And then that gets you into being able to convince and have people talk about the fact that, wait a minute, you know what, being sustainable, transitioning to renewables actually saves me money over the long run. It doesn't cost me money. That's an entirely different mindset that if we can get to, really, I think will drive a better narrative and a more accurate narrative going forward.
That is fascinating. And I have had the privilege of watching and reading the evolution of your impact reports. And I will certainly link to your impact report in the show notes, because I think our listeners, and I know for me, I really enjoy hearing these anecdotes on where these impacts are made and how they're made. So I will certainly link to that impact report in the show notes at thelongterminvestor.com. I hope you all check it out. Steve, I just have one other question. Again, it was such an honor to have you talk about this topic. And I'm just kind of curious, how did you get interested in this space within fixed income to begin with?
It's I get asked that question a lot, and it was always something that I thought was interesting. Being older and not having been exposed to the concept of responsible investing, because like we talked about originally, wasn't it's still nascent in the fixed income market, so it really wasn't discussed. But I always thought about the fact of how we could possibly incorporate those concepts into public fixed, because the nature of the market, like I said, about who issues, how it issues, we don't have the vote, right? So we can't control corporate policy, but we do hold the ability to fund, we do hold the capital, right? And most issuers come to the fixed income market far more frequently than they ever go to the equity market. So the ability to control and direct how capital was being deployed and obtain data back, to me, made a lot of sense. And it seemed like there was a great opportunity. And I feel that a lot of our issues in society have been driven, unfortunately, by finance and not understanding what it is, or having misleading claims about it. But I think that the opportunity to maybe correct some of those things and some of those factors are also possible with finance. And I think that that's really a great opportunity for us to utilize the markets in a way to, again, live up to the potential of what markets are supposed to be, which is most effectively and efficiently deploy capital. And the opportunity to do that in a sustainable way, I think would allow us to really transform how we approach finance as a whole and leave the world a little bit better of a place. I have a 15-year-old daughter, and so I'd like us to have been able to contribute something positively to the future that she's going to be inheriting. And I think this is a great opportunity to do it. And it's a way I think it can be done profitably. And that's really the key, that these are not mutually exclusive concepts, and they shouldn't be thought of or treated as such.
Well, I appreciate that response. Very interesting. And like I said, I will link to the impact report in the show notes. Are there any other resources that you might recommend for someone who's trying to learn more either about ESG investing in fixed income or equities or the space and development as a whole? Any places you'd point people to?
Sure. There's a lot of really good work done. We have a couple of white papers on our website where we talk about our approach. One of the most important things I think that, hopefully, a reader, that they'll glean from our impact report. And I recommend either caffeine or alcohol while reading it, because it can be a little dry because it is fixed income. But there's some really good stories about and case studies that really explain the process and the approach and really dig down into how we evaluate a transaction and the outcomes that we're measuring out of them. But it also, I think the most important thing that I've found in our impact report has been the equivalencies column, which would be the furthest right column on the calculations. Because, like the calculation we were talking about with megawatt hours of power produced, I don't know what I got a D+ in physics in college. So the equivalencies allows me to understand in a real world sense how the capital has been deployed and the efficacy of that capital and the magnitude of the impact that you've had. And I think that really helps the average person get a sense of what's being funded, but also the outcomes associated with it, which are really critical. But also, the ICMA, ICMA, the International Capital Markets Association, has some good work on their website that talks a little bit more in depth about green bonds and social bonds and sustainability bonds. And I think that serves as a really good primer to help people understand exactly what it is you're trying to get accomplished and what's being done in this space.
Well, I appreciate the suggestion, Steve. And again, I will dig into some of those and curate for all of our listeners some resources from what you just pointed to share in the show notes. And if you are watching us on YouTube, please be sure to like and subscribe. That really helps other people find the show. If you're listening on Apple Podcasts, do the same. If you leave an honest review, you'd be surprised at how much easier it is for people to find the show when you do that. But Thank you again, Steve, for joining me. And until next time, to long-term investing.